Welcome to the deep dive. Today, we're jumping right into something really core for your business finances, choosing your accounting method. It's much more than just bookkeeping, isn't it?
Oh, absolutely. It's a major strategic decision. Really impacts your tax bill, your cash flow.
Exactly. So our mission today is kind of simple. Cut through the IRS complexity, give you the inside track. Think of it like a shortcut to understanding how these choices can, optimize your taxes, put money back in your pocket.
And we'll definitely unpack the big ones, cash versus accrual accounting. Plus, we'll get into some, let's say, more advanced strategies for specific assets. And maybe flag a few common pitfalls to watch out for, things you really need to avoid.
Okay, sounds good. So let's tackle that first big choice. When do you actually record income and expenses for taxes? The timing question.
Right, the fundamental timing.
So the cash method, that one seems pretty straightforward.
It is, generally. Income is counted when you get the cash, or, importantly, when you constructively receive it.
Constructively received, like a check sitting on your desk.
Exactly, even if you haven't deposited it yet. And expenses, deducted when you actually pay them.
So it lines up perfectly with your bank account, basically.
Pretty much. Then you have the accrual method. That's different. Revenue gets recognized when you earn it, like when you finish a job or send the invoice.
Okay, even if the payment hasn't come in yet.
Correct. And expenses are recognized when you incur them, like when you receive a bill. Doesn't matter when you actually pay it.
Right. This method gives a clearer, sort of longer-term financial picture. JAP prefers it.
It does. But here's where the IRS rules get really interesting, especially for what they call small business taxpayers. There's this threshold. If your average gross receipts over the last 3 years are under $30 million for 2024,
30 million, okay.
you can generally use the cash method, even, and this is key, even if you have inventory.
Oh, wow. That simplifies things a lot for retailers or manufacturers below that size. Huge tax deferral potential, too.
Massive.
Yeah.
But there's a potential snag, a sort of strategic cliff.
Ah, okay. What happens if your business is growing fast and you cross that $30 million line?
Well, then you're usually forced to switch to the accrual method.
Forced switch, okay. And the problem is?
The problem is your accounts receivable. All that money customers owe you that you haven't collected yet. Under the cash method, you hadn't recorded it as income. But when you switch,
But, uh-oh.
the IRS hits you with what's called an IRC Section 481A adjustment. Basically, all those receivables suddenly become taxable income in the year you switch.
Even though you don't have the cash.
Exactly. It creates phantom income. Can lead to a surprisingly big tax bill you weren't expecting.
Ouch. So planning ahead for that transition is absolutely critical.
Crucial. You need to anticipate that potential hit.
Okay, let's shift gears a bit. Beyond the basic timing, where else can accounting choices really save you money? Maybe with inventory?
Yes, inventory valuation is a big one, especially when prices are rising, like now. The LIFO method, last in, first out, can be a really powerful tax deferral tool.
LIFO, how does that work again?
It assumes the inventory you bought most recently, which is likely the most expensive, is the first stuff you sell.
Okay.
So that increases your cost of goods sold on paper.
And a higher cost of goods sold means lower taxable profit. Less tax.
Precisely. Significant tax deferral.
Sounds great. Is there a catch? A trade-off?
There is. It's called the LIFO conformity rule. Big one. If you use LIFO for your tax return, you have to use it for your financial statements too.
Ah, the ones you show to shareholders. Or the bank.
Exactly. So using LIFO will also make your reported net income, your earnings per share, look lower on those public-facing documents.
So it's a balance. Tax savings versus maybe looking less profitable to investors or lenders.
It's a strategic choice you have to weigh carefully.
Got it. What about other big-ticket items? Like buying equipment, buildings, fixed assets? You can't just deduct the whole cost up front, can you?
Generally, no, you depreciate them over time. But tax law gives you ways to speed that up significantly, accelerate the deductions.
Okay.
Two main tools, especially powerful right now. First, Section 179 expensing. This lets many businesses immediately deduct the full cost of certain assets in the year you put them into
The
service.
full cost. Up to a limit, I assume.
Yes, there's a limit. For 2024, it's quite high, $1,220,000.
Wow, okay. 1.2 million. That covers a lot of equipment for many businesses.
It does. Then, on top of that, there's bonus depreciation. This lets you deduct an additional percentage of the asset's cost in that first year. For 2024, that percentage is 60%.
60% bonus after potentially taking Section 179.
That's right. Though keep in mind that 60% is phasing down in the coming years.
Okay, so how do these work together? Is there an order?
Yes. Think of it like a waterfall. You apply Section 179 first, maxing that out if possible. Then you apply the bonus depreciation percentage, the 60% for 2024, to any remaining cost. And then whatever's left gets depreciated normally using the standard MCRS rules.
So using this waterfall strategy, you can potentially write off a huge chunk, maybe even all, of an asset's cost in year one.
Absolutely. It can dramatically lower your taxable income in the year you make those big investments.
Powerful stuff. Now, you mentioned cash flow earlier. Let's loop back to the cash method for a second. What happens if you're on the cash method, you provide a service, send an invoice, and the customer just never pays? Bad debt.
Yes. This is a really critical point, a common pitfall for cash method businesses. If you use the cash method, you generally cannot claim a bad debt deduction for services you weren't paid for.
Really? Why not? It feels like a loss.
Because you never recognize that income in the first place. Remember, cash method means income is only recorded when received. Since you never received it, the IRS says there's no corresponding income to offset with a loss deduction. The expense wasn't paid either in IRS terms.
Huh. So no income recorded, no deduction allowed. That's a definite downside if you extend credit often.
It's a significant disadvantage, yes. Accrual method businesses can generally deduct bad debts because they already recorded the income when they earned it.
Okay, that makes sense. So pulling all this together, what's the big takeaway for our listeners?
I think the main thing is that choosing and managing your accounting methods isn't, a set it and forget it task. It's dynamic. It's strategic. The rules change, your business changes, you need to stay on top of it.
Right. It's not just about compliance, it's about active strategy. So maybe here's a final provocative thought for you to consider. Often, the biggest strategic wins in the tax code aren't the standard rules, but the exceptions.
That's a great point. Like with long-term contracts, perhaps.
Exactly. Like maybe using the completed contract method instead of percentage of completion. It's often way better for tax deferral.
But you have to qualify for it, right, through exception.
Precisely. Like the small contractor exception. Again, that $30 million threshold for 2024 is key there.
Right.
Or maybe the home construction contract exception.
Understanding and qualifying for those exceptions, that's where the real optimization often lies.
It really underscores why talking this through regularly, maybe annually, with a good tax professional is so important,
Right.
especially as your business grows or, tax laws inevitably shift.
Absolutely. Proactive planning isn't just defense, it's your best offense, too.